Hi there, welcome back to the channel. So today we're going to be discussing how I'm able to essentially make $5 a day simply because I have a short position in Tesla. And this is obviously within the crypto space, so we're going to discuss the two projects that are involved when it comes to essentially getting these sort of returns. And the two projects are essentially Mirror and Anchor. But let's talk about Mirror first, because that's essentially the main platform, since that is where you can trade synthetic assets, right? So they have a front end to it, essentially meant for typical people that are looking to come in and maybe purchase a synthetic Apple share, a synthetic Coinbase share. As you can see, they have right now about maybe 20-25 different synthetic assets here. They obviously plan on adding more. I would say right now, every week, we see 2 to 3 new assets being added to the list. So even if you're just interested in essentially just buying, even coming here and just buying Amazon with your crypto, it is possible. You simply need UST, which is the stable coin for the Terra blockchain, right? So this is all happening within the Terra ecosystem, and Mirror, as well as other project that we'll talk about, Anchor, is also on the Terra ecosystem. So a big difference you'll see is that typically if I were to take Tesla, because we're using Tesla in this very example, if you want to short Tesla on the NASDAQ exchange, you're actually going to be paying an interest for doing so. It's not much for Tesla. I believe it might be down to 1 to 3% right now. I'll get a screenshot up on that. But usually you pay an annual interest for trying to short a company. On the other hand, if you short a company with Mirror, you actually get rewarded for that. And why is that, right? It sounds a little bit too good to be true. And that's because for these assets, the way they're priced, it's not as though it pulls the price directly out of the NYSE exchange or the NASDAQ exchange. There's actually a secondary market in the sense that the traders within Mirror are trying to match up the price, right? So if we go to a stock such as Airbnb, now for starters, UST is essentially supposed to be pegged to the dollar. So if we see 142 UST, that should be 142 US dollars, right? So the price right now is $142. The Oracle price is $138. So what's the difference? Well, the Oracle price is the actual real life price of the asset. So if we check the market right now, if we type in Airbnb, it's currently at, in the after hours, about 138.68. So very close, right? 138.65. But on Mirror, it's being sold for 142. It's being sold for a premium. The premium is being depicted right here at 3.1. So what does the platform try to do to bring down the difference, right, between what the Terra price is? This would be considered the Terra price, right? This is the price that people are exchanging right now in the Terra ecosystem, and the actual price. Well, they want people to come in and obviously sell, right, to bring down the price. And one way of doing that is essentially giving rewards to people that are willing to short the stock, because shorting stock obviously provides downward pressure on the stock itself. So that's the initial explanation on it. And I do have a presentation. We're going to be using this to essentially go through the steps, so it's easier for you to kind of visualize and follow what I'm saying. So if we, so we're starting off with $4,600 of UST, right? That's our starting point. That's what I began with, by the way, because I already have this position out there. From 4,600, we go on and we deposit it into Anchor. So what is Anchor? Anchor is essentially a borrowing and a lending platform where if you want to borrow money from Anchor, you essentially come in, you can give collateral, and they'll give you UST in return. And on the other hand, if you want to lend money through the deposit feature, deposit option, you'll be paid a 19.5% interest rate on it. And the idea is that Anchor essentially takes the collateral that was provided on the borrower side, and they stake that, and they give a large portion of it over to the lenders, right? As well as the borrower APR, which is 15%. So that's how that's being funded. So if we go back, let's just go back to, so step number one, we take the 4,600, we deposit it into Anchor, in which case we get paid 19.5% annually, which comes out to about $900 annually and $2.47 daily. And this comes in at clockwork. There's no actual market that moves this around. It just comes in clockwork every 6 minutes. Now, when you do deposit your UST of Anchor, they give you aUST in return, which you will see in your Terra wallet. This token appreciates against UST, so the count of your aUST doesn't rise. And then we use the aUST as collateral to trade stocks, which is where Mirror comes in. So for example, just to better understand what I mean by appreciating against UST, if we were given $1 worth of aUST, on day one it's worth, let's say, $1 of UST. The very next day, we still have the same amount of aUST, but now if we were to exchange it, it's actually worth 1.005. By day 3, that same one aUST is worth 1.01. Now, obviously, I didn't crunch the numbers to figure out the exact increase, but this is just to give you a general understanding of what happens when you hold aUST, since we are going to be providing it as collateral. If we head over to the next slide. So shorting Tesla of aUST on the Mirror protocol. We're going to bring up, so this is the Mirror side for those that are looking to farm, right? Yield farming. Either you want to provide a liquidity pool, you want to contribute to a liquidity pool, or you want to short farm, which was essentially opening up a short position. Whenever you want to open up a short position, you have to provide collateral, right? Because you're borrowing something, right? In this case, if we want to, if we want to borrow 1 share of coin, we got to provide collateral for the share that we borrowed. So the nice thing is, with the recent update that Mirror had, they allow us to use the aUST as collateral, right? So the $4,600 that we deposited, we're able to use that as collateral to then borrow shares on Mirror. And even while doing so, the aUST is still appreciating it. It's not as though it's not our aUST, even though it's being used as collateral. It's still ours, and when we get it back, it's still appreciating against UST day after day. Now, typically the safe collateral amount is about 200%, right? I think on coin it's actually sitting at 250 here, but a lot of these assets, if we go head over, we could just take Tesla for example, it's at 200%, right? And then notice that you do get liquidated at a 150%. So in this case, if Tesla were to rise, I believe about 24% or so, your position would be somewhat in danger, where you would either have to reduce your size or add more collateral. Otherwise, you will be liquidated out of your position. And just to make things simple, so every $2 worth of aUST that we have, you will be allowed to short $1 worth of Tesla. In our case, $4,600 of, this is, there you go, of aUST, and we shorted $2,300 worth of Tesla, right? That is my current position. 20% API on the Tesla short. So the API does fluctuate. It fluctuates on an hourly basis. Every hour you're going to see these APIs going up and down. And why is that? Because it's strictly, for the most part, it's connected to what the premium is. If there's a very small premium between the Terra price and the Oracle price, the API is not going to be high. If there's a large difference, the API is going to go up. I like to take 20% as the average, because as I said here, some days it's as low as 5, and other days I see as high as 100% and above. So 20% I feel is pretty is a safe approach to take. I mean, I think right now it's on the low side. As you could see here, yeah, this Tesla is only at 8%, but I know a couple hours ago it was around 35%. So usually in a rising market, it's going to kind of stay towards the downside simply because the Oracle price, right, which is the real price, right, the real price, if the market's going up, it's actually naturally reducing the spread between the Oracle price and the Terra price, right? The market's falling, if anything, the spread typically widens, right? Because the Terra price is not able to catch up to the Oracle price at the same rate. So that's one thing to keep in mind, right? If we have a slow, steady, bullish market, APY is going to be a bit lower. If it's a bit more volatile, if it's downwards, then these APYs really go up to the sky. Like last Friday when the markets came down hard, the APYs on all of these were actually like at 75% and higher. I think silver was at like 130%. So it's going to move around. So I think 20% is a very reasonable number to take. And if you look at 20% API on the $2,300 short position, right, which is a Tesla short, then we earn $451 annually and $124 daily. Okay, so on this next slide, we have to wait 2 weeks. And we're going to go into why. But how does a short work, right? Now, I'm giving you an example here. We borrow 1 share of Apple at $100 a share. Now, the moment it is borrowed, it is sold for $100 right away. You now own 1 share of Apple to the brokerage, right? Now, if Apple were to drop to 90 in the future, then we can purchase 1 share of Apple from the market and then use that share to satisfy the borrowed share on the short side. In this case, we made $10, right? Well, in Mirror, that $100 that you received from selling 1 share of Apple will be released to you after 2 weeks. In our case, we'll receive the $2,300 USD after 2 weeks. So this is also a very big difference compared to the typical brokerages you will find, whether it be Fidelity, Robinhood, or Ameritrade. If you open up a short position, you can't really touch that money, right? Even though you're short, even though technically you sold that share of Apple and you should have gotten money for it, they don't really let you use that money for anything. On Mirror, though, they do. They give it right back to you after 2 weeks. So if we head over to Mirror, you can see that right now, so there's a column for locked UST. So this is any position that was opened up within the last 2 weeks, right? And then we've unlocked UST. So 2 weeks have passed, and now we can come in and actually claim the money. So this is usually how it's divided. Adding back to Anchor. After 2 weeks, we're going to claim it, and we're going to have $2,300 worth of UST in our wallet. Now, we're going to be taking that UST and obviously putting it into Anchor. I feel that's a safer approach. And when you want to close that short position, so one day when I want to close that short Tesla position, I'm going to simply withdraw my UST from Anchor and use that money to cover my short position. Now, by taking this essentially $2,300 back that we received, if we put that back into Anchor as well, as you can see, it comes out to $448 annually in interest or $123 daily. So where is our money, right? So after all this, we have $6,900 in Anchor, right? Only $4,600 of it was our principal, meaning the money that we came to the table with, the money that I actually deposited, the money that I transferred over to the Terra wallet, $4,600 was my own. We also have $2,300 in Mirror. 0 of it is from our principal. Okay, so we were able to get this position in Mirror without having to provide anything else. So in total, we have $9,200 worth of UST invested, which is earning on Anchor, we're earning $3.68 daily, and on Mirror, we're earning $1.26 daily, right, for a grand total of nearly $5 per day of interest that we are earning. So percent-wise, if you look at it a different way, if we calculate those rewards, so that interest on our actual principal, which I feels like a fair comparison, then the APR is actually 39%, right? That's the return that we're receiving on our capital here. 39% return. And that's just by being short on Tesla. Now, obviously, listen, if we're short on Tesla and Tesla goes up, yes, we are going to be taking losses on that, obviously. But the goal is that Tesla's not going to go up 40% over the course of the next year. I mean, that is the goal. Now, we do know that last year Tesla went up like crazy, so it's important to kind of understand what assets you do want to short on this platform. But since Tesla is now a $600 billion company, you know, for it to go up 40% is a big thing. And I just don't think it's there. Again, if you want to take things, you know, a bit safer, I mean, you can go after, again, the bigger stocks. If you look at something like SPY, I mean, you can see the percentages right now really, really low on a bunch of these because the market kind of was up today, right? You do have Twitter that is sitting up higher, Square, Netflix is sitting up higher. But you could definitely take a look and see, you know, as long as, you know, the stock doesn't really exceed 40% annually, you're coming out ahead. You're coming out ahead. Obviously, a company like Apple or Microsoft just can't go up 40% in a year. I mean, they're trillion-dollar companies at this point. And if it goes down, I mean, you'll take profit. So a way for us to quickly look at this. So when you usually open up a position at a 200% collateral level, an easy way to kind of keep track, even though you should have your own Excel file for it, is simply looking at the percentage here, right? So obviously, if it says I actually have 203% of collateral, it went up from 200%, right? So it's kind of fair to say for me that Tesla must have come down for my collateral to have gone up the way it had. So let's take a look at silver, right? This borrowed amount, so again, we actually borrowed 32.9 shares of silver, right? So the value of it is always moving around, and we own 32.9 shares of silver. We don't own this amount back. We own specifically the shares, right? So this number, the 468, always changes. It essentially tells me the value of this position. But when we sold silver that day, we sold it for 803 USD, right? That's what we were paid. That's what we were given on that day, 803. But right now, if we were to repay it, we would have to only use up $768 to repay back all those shares. So on silver, we're currently profitable, which is also seen here in the 208 collateral. Now, this is not the most accurate way of viewing it, if you basing it on the collateral side, because as I said before, your aUST is appreciating, right? Every single day it's going up. So if anything, your collateral improves on its own day after day after day. That's one thing to keep in mind. So obviously, if you're holding this position for months, right? Well, if Tesla, let's say, never moved a penny from day one of me shorting it, and there's been months of my aUST appreciating, well, this number could have gone up to 205 on its own just from that. So that's one thing to keep in mind. And if you quickly look, obviously Amazon is hurting me the most at the moment. So it's our last slide, right? Compounding. Now, when it comes to Anchor, it's already automatically compounded, and the compounded return is 19.5% per year. But on Mirror, you do withdraw the rewards whenever you want to. So if you look right now, I have $11.75 to withdraw, of UST to withdraw. Right now, twice a week, I come in, I withdraw. So what was it? So yeah, so just a couple of days ago, on the 21st of July, I withdrew 7.5 of Mirror tokens. Mirror does obviously pay you in Mirror tokens, and this is the current price of it. Now, what you do with it is I kind of note here, it's up to you. I mean, you could just take your Mirror tokens and just maybe even just stake them in governance. It's just simply a way to get involved in the project, and you can kind of vote in the direction, and you do get compensated for it, so 25% APR, right? So you could take your rewards and essentially compound them if you would like to, or maybe you just take that and just go on and I mean, for example, so this is the app you could use for for Terra blockchain, right? It's called Terra Station. So if I want, I can come and swap, and you could simply take your Mirror tokens. I don't hold any Mirror at the moment, so it's not available, but you'd simply take your Mirror tokens, and you would be able to just swap it to, let's say, back to USD and do whatever you want of it, right? You could send it back to some brokerage if you want to buy some Bitcoin of it, or whatever you'd like, right? So way either compound your returns or simply, buy into some other cryptocurrency. So that's definitely an option. So as we went through all of this, it's time for us actually to do the last part of it, right? So I have my Tesla position, right? You could see it here, right? I shorted Tesla twice on 2 different occasions, so it shows up separately, right? Once and twice. But when it comes to the short farming, it's shown once right here, and we have the 2300 UST available here. So we're going to claim it now. We did have actually all our stocks here on lock today and yesterday. So when we do claim, we're actually going to be claiming all of these. But we're going to be taking specifically this amount, and we'll be dropping it into Anchor, so you can just kind of see the process when it comes to that. So we hit claim UST. There's a 10-cent UST fee. We're going to hit claim. Just going to enter this. Right, so we want to, where is it? Yep. So we want to add 2300 to Anchor from here. Okay, perfect. Okay, so let's slide over to Anchor. Now, do keep in mind when you use your aUST from Anchor as collateral on Mirror, you don't visually see your aUST here anymore, right? Even though you can kind of see how I've made these deposits before. Once the aUST is used as collateral, it doesn't appear here, but it doesn't change the fact that it's still earning its interest, right? So let's hit deposit, and we're going to deposit 2300. So there's a fee here. So this is actually the cap fee. You never pay more than 1.67 UST on Anchor when it comes to depositing. So obviously, the more you deposit in one shot, the better. The fee takes up a lesser percentage. So let's click on proceed. So you just quickly see the steps. Submit. And there you go, right? So the deposited amount, and we received this much of aUST, exchange rate, and then the fee. Okay, perfect. And that is it. Now it sits right here. So again, this is the money that we received from shorting Tesla. And the only reason we were able to short Tesla was because we used our previous sum in Anchor as collateral to then short it. So it's definitely a nice way to essentially leverage your way up for good returns, right? So I would personally just leave the balance here, and if I want to cover my short, I would just simply come in, hit withdraw, and it's as simple as that, and I have it right back into my wallet. So now that we have our UST here, I actually want to show you just a quick example of how the shorting process kind of works. I've kind of skipped over that. So since I do have that aUST there, even though I'm not going to submit the transaction, I'm actually just going to show you how it's set up, right? So we take our aUST. Let's say we're taking all of it that we have right now, right? So everything that we got for this deposit. If we take it 200% collateral, right? So we're shorting about 16 shares of Twitter, right? And this is how much we're going to receive back after 2 weeks, as it says, right? Which, as you can tell, is half of our collateral, right? So all the math checks out. All we have to do is simply hit farm, submit the transaction, and now you're short on the position. One thing to note is that there is a 1.5% fee of the minted value when you close the short position. So when you do cover finally, you will pay 1.5% fee of the value of the total on the total transaction, okay? which kind of sucks, right? So you can't really go in and out, which is kind of what they're trying to go up against. They don't want people to really to just, hit that short and the premium comes down just a little bit and then they cover, and all of a sudden they're dealing, because when you cover your short, you're actually providing the buying pressure, right? So they want people to kind of stay in a short position for a longer period of time. So that 1.5% fees kind of meant to kind of push you towards that direction. So it's one thing to keep in mind when you do make your calculations, right? Obviously, on these short positions, I would love to come out profitable on them as well. That over time, maybe later this year the market's gonna be in turmoil, and overall the market's gonna be down. If that's the case, I'm making my typical interest as well as my actual positions are up, right? So if I plan to cover them then I'm also going to make money on that, right? Because I have to use less USD to buy back those shares as I was given to begin with, right? Now, one little interesting thing you'll notice actually, so the APYs are actually paid based on the borrowed amount, and as we know, this borrowed amount constantly changes, right? The value of the borrowed amount. So if the position actually goes against us, so like in Amazon's case, right? You can tell by the collateral, or we just look right here, right? So we just took away the USD from here, so we can't look at it like that. But as it goes away from us, that means that Amazon obviously is more expensive, which means we're borrowing more, which actually means the percentage, the APY that we're getting on Amazon, actually increases because we're borrowing more. On the flip side, if we're correct on the trade, right, as we were on Netflix or silver, then actually the borrowed amount goes down, so we're earning interest on a lower amount. So that's one little interesting combination that exists. So I would say there's almost like a sweet spot where you kind of want the asset to go against you, just by a bit, maybe 5 to 15% against you, and kind of stay there for as long as possible, because then you're really going to be milking those returns. Now, if you have any questions, feel free to leave them in the comments. I'm going to have many more videos coming out about Mirror, about Anchor, the good and the bad for both of them. If you're confused, again, just leave in the comments. If you're interested in this type of content, then just hit the subscribe button. I would appreciate it, and the thumbs up would be fantastic. Other than that, have a great day. Thanks.